Hi folks, this is Big Mike Zlotnik. Today we're going to record a short video and talk a little bit about tax loss harvesting. As exciting as it sounds, hope you can appreciate some of the strategies, how to save on taxes. The first disclaimer is I'm not a CPA. I don't play one on TV. Consult with your CPA professional before using any of these strategies. But tax loss harvesting is a very powerful idea. What does it mean? It means that you can actually harvest passive losses from the investments in real estate, for example, multifamily projects. It could be many other asset classes, could be storage, could be others that generate substantial passive losses driven by bonus depreciation. So typically a project, a multifamily or a storage would run a cost segregation study. The result of the cost segregation study that typically in the first year depreciation through the bonus depreciation allowed, and this varies obviously project by project. Multifamily investment could get easily 30% roughly of the total project investment as a first year depreciation. Why is it possible? The tax law allows for the 5, 7, and 15-year schedules to be depreciated in 1 year as a bonus depreciation. This is the current law. Over time, it may change, but right now it's highly advantageous tax environment. So an acquisition of a multifamily real estate property, say $400 million, 100 million, just to clarify, could get first year bonus depreciation around $30 million. And these projects are bought with leverage. They're bought with debt. Typically, they're bought with qualified non-recourse debt, where the project operator or sponsor secures bank financing. Typically, it's called qualified non-recourse debt on most of these commercial projects. So that $30 million loss is typically attributed to all the equity investment of the project. So what's really interesting is that a project could have, instead of a 30 million all common equity, it could have preferred equity and a common equity. And a preferred equity could get very little depreciation and the rest could fall into a common equity. So an example, in this type of example, imagine of the $30 million total equity, $18 million is preferred equity and $12 million is common equity. And preferred equity, for the sake of the argument for now, gets very little or no depreciation. It can get some depreciation. It's subject to the discussions and negotiation, but technically say it gets nothing. So $12 million equity would get $30 million depreciation in the first year, which is basically 2.5x. For every dollar of equity investment, there is $2.5 of depreciation received to equity investors in the first year. So that depreciation passes through as a loss, which allows investors to take a loss greater than the capital that they invested. And if you're not familiar with the tax law, you're going to ask, how is it possible? I invested $100,000 and I'm getting $250,000 passive loss in the first year. Well, the tax code allows it. There are certain, obviously, requirements that have to be met, but assume all those things are done properly, the K1 will show a loss of approximately here 2.5x. So $100,000 investment would show $250,000 first year loss. Now, how do you use it? Well, that's where the tax loss harvesting comes in. You've harvested the loss by making the investment of $100,000, receiving $250,000 of first year depreciation. What do you do with it? Well, there are a few really great use case scenarios. So number one is that if you have gains, passive gains. So depreciation is a passive loss. It generates a passive loss. So that $250,000 you received on a K1 loss is a passive loss. If you have passive gains, such as capital gains from a sale of real estate you held passively. So you invested in another project, in another building, in a multifamily, single family, storage, whatever it might be. And on sale of that asset, you generated capital gains. or passive investment gains. And you can offset them with the passive allocation losses, which is effectively tax loss harvesting. You harvested the losses from one investment and you helped offset the gains from another investment. So any kind of a passive gain can be offset with a passive loss. Also remember that real estate rental income generally is a passive income as well. So you can offset rental income with the depreciation that you receive by using this tax loss harvesting concept. There's another interesting term for this passive loss harvesting. It's called pseudo 1031 exchange. Means that instead of selling an asset through 1031 to exchange it into another one, you basically sell outright and then invest in a project that gives you these passive losses. So equivalent of a 1031 exchange. That's generally kind of a high level how it works. As a real estate professional, for those who are real estate professionals, they could potentially use these losses to offset their income from other sources. Again, as real estate professionals, all losses and gains are active because of that status. So there's no more passive losses, they become active losses. And they can offset gain from that, from another source. So for example, if a couple, husband and wife, as wife as a doctor, as a dentist, as a real estate, as a non-real estate professional, just doing whatever the business that they're doing. They have practice, they have any other business that generates income. And then the spouse is a real estate professional. And there are certain requirements to meet the professional, 750 hours a year. It has to be their primary business. They can't be doing something else, spending more hours than real estate. So if the requirements of real estate professional are met and a proper grouping election is done on their tax return as a joint filers, they can use the depreciation losses to offset income from other business. So it's a very powerful idea if it's done properly. So I just want to take a couple of minutes to chat about this. Once again, I'm not CPA, I don't play one on TV, consult with your CPA professional. But with the right CPA advice, you could exercise these strategies, either help offset your capital gains from sale of real estate or rental income, or if you're a real estate professional, you could offset other income from whatever business that you have. That's about it. I hope this was as exciting for you as it was exciting for me. It's a cool subject, certainly very applicable to real estate investing. And we're about to launch Tempo Grow Fund 2, which utilizes a strategy to accelerate the tax benefits for folks who invest in Tempo Grow Fund 2. We have Class B units, which basically give investors outsized depreciation with a very similar concept. We're doing it on a fund level instead of individual deal level. We basically bringing in Class A equity as preferred equity and allocating the losses to the Class B units as a similar concept. So if you have interest, please reach out, request a PPM. That's the formal offering document to accredited investors only. I appreciate your time and attention. This was not a solicitation. This is purely educational, informational, and I don't give advice. So consult with your professional once again. Thank you kindly.